What is going on, YouTube, and welcome back to another Fridge Financials video. And today we talk President Joe Biden's capital gains tax proposal. What does it mean for you? What does it mean for me? What does it mean for our economy? Watch this video and stay tuned to find out. So if you're excited for today's video, make sure that you smash the thumbs up button, subscribe to the channel, or consider subscribing at least, and turn on the bell notifications for all future uploads. We are at 97 subscribers at the time of me recording this. My goal was to get to 100 by June, and we are way above that goal so far in terms of, we still have a little over a month left here. So if you're watching this video and you're not subscribed, consider subscribing. Of course, it is free of charge, as always. Now, I've done a lot of research, historical research, looking at politicians, looking at the past, looking at what it can mean for us. So I want to just bring you some different perspectives as to what this could potentially mean, and does it have an impact on your investments, your assets, your income, and those kind of things. But again, full disclosure, I am not a financial advisor. I'm also not a financial analyst. I don't work on Wall Street or work for big corporations. So keep that idea in mind. And I'm also not someone who goes either way in terms of politics. I'm not on the Republican side. I'm not on the Democratic side. I'm kind of just neutral and kind of in the middle, as I always have been, depending on what it is I see and what I read up on. And this year is an election year, so we shall see what happens. So Grant Cardone, if you have no idea who this guy is, he is one of the wealthiest real estate investors that I've seen either on Instagram, Facebook, Googling his name. Like, he has a lot of money. And he's very opinionated in a way. He does back it up with some facts and everything else. Now, I don't watch everything he puts out there, so I'm not going to say, oh yeah, he's great, when I don't really know. He does make some interesting points on this article here that's posted on Yahoo Finance. So Grant Cardone slams Biden's 44.6% capital gains tax proposal, warns entire country went red last time. By this, he means went red in terms of being Republican, the last time we had such a high capital gains tax proposal. And we're going to get into that. So President Joe Biden's budget proposal for fiscal year 2025 includes significant changes to the capital gains tax. This is the tax on qualified dividends and profits from the sale of assets like stocks, bonds, and real estate. Long story short, how it works is when you sell any kind of asset, stock, bond, real estate, whatever, and you make a profit, you have to pay taxes on it. Okay, government gets their share of it. Now, there's two different sides of it. There's what's called short-term capital gains, which is if you sell it within a year, and there's long-term capital gains, which is if you sell it after a year. Okay, so the reason why they have this set up in place is that if you hold your assets for longer than a year, you get a little bit more of a tax benefit. Right now it's at 20%, whereas maybe you might get taxed at 30% if you sell it within a year. So it encourages people to hold long-term, have their investments locked in for 5, 10, 20 years, and to take advantage of those tax, advantages, essentially. So the president's budget promises to end one of the most unfair aspects of our tax system. Now, besides restoring the top marginal income tax rate to 39.6% from 37%, Biden wants the country's wealthiest to pay the same tax rate on their investment income as middle-class families pays on their wages. Basically, he wants to impose this tax that's going to affect the super wealthy to try to make our economy as a whole more balanced, where the super wealthy don't get as many tax breaks. They don't save as much money as compared to what we do, because we don't have the luxury of that kind of thing and everything else. For the highest earners, those with taxable income above $1 million and an investment income above $400,000, the long-term capital gains tax could reach 44.6% with a combination of proposals. So by that, he means, again, if you make over $1 million and an investment income over $400,000, the long-term capital gains could reach 44.6% with a combination of proposals. It's not just one proposal and that's it. There's a combination of different proposals that he wants to have built in that'll effectively add up to be 44.6%. So what does that mean for me? Nothing, because I'm not even close to making $1 million a year, and not even close to making $400,000 in investment income in a year. And if you're watching this video, just like the 99% of us in this country, we aren't making that much money, so it's not going to impact us directly. Okay, real estate mogul Grant Cardone is not a fan of the agenda, again, because he has a extremely high net worth and wealth, and he's growing his business up. Biden proposes 44.6% capital gains tax from current 19%. Can't even come up with his own ideas, taking a page out of Trudeau's playbook, who raised Canada to 66%. And did fact check that, which as you can see here, Trudeau did raise it up to 66%. So this is the Prime Minister of Canada. So he's proposing to raise it up to 66% to help with the housing market and everything else up in Canada. Now, as you can see here, it's only going to affect 0.13% of the population, just like what Biden's proposing this tax for the U.S., the top 1% essentially. This is very specific at 0.13%. But what's crazy is that they were already at a 50% tax rate for capital gains. That's really high. I didn't know it. We're not even getting to 50%, but they're looking at pushing it up from 50 to 66.7%. So 2/3 of it for those super wealthy. There's one, and then I highlighted this one section right here, which I think is very, very important to know. And again, this is from Robert Esselin, whatever that is, Senior Vice President of Policy at Business Council Canada, who nevertheless criticized the tax on the wealthy. Wealthy people always have a choice to invest here or elsewhere, he said, adding that the increase in the tax would chase capital away from the country at a time when it is desperately needed. Obviously, all the economies are still trying to get out of this crisis of the high inflation and everything because of the pandemic, and then having an influx of money and having super high expenses for inflation and everything else. So at a time when the country needs it, they need the businesses and everything else, think about it in terms of, I guess this is the way I would look at it. Imagine you are having a huge, successful company, millions of dollars, $1 billion, even whatever, in Canada. And they say, hey, starting next year, you're going to pay, instead of paying half of your capital gains to us in taxes, you're going to pay 2/3 of it instead. If I'm a company and I'm being told that, and then I look at the U.S., who borders Canada, and right now we're proposing 44.6%, so about 22% less, I might be like, you know what? Can I move my company out of Canada? Can I move it to a different country with better taxes for me, for my company, so I can get more of my profits that I've built up over the years? Possibly. Obviously, some companies might not do that, but some companies might. This might be the factor to push them out of Canada and to push them somewhere else. You never know. So he makes a very valid point here. The wealthy can go work and put their money into different countries and different economies, whatever, if these taxes are too high. So it's something that has to be very, very carefully calculated in terms of capital gains tax rates and everything else. So definitely very, very true. Again, it is happening also in Canada, not just the U.S. Now, of course, as you will know, Canada's economy is not nearly as big as the U.S. The U.S. is the number one in terms of rank for the global economies, followed by China, Germany, so on and so forth. And it's based off of their GDP, which stands for Gross Domestic Product, which focuses on, again, things like calculations of imports versus exports, policies, and all those other things built into it for the GDP. And U.S. has the highest one. So obviously, it's crazy to me that, but we also have a higher deficit, of course, as well. But anyway, so again, number one economy in the world versus number 10, but a huge percent from Trudeau, which is crazy. I didn't even know about that till I read this, which is crazy. So currently the highest long-term capital gains tax is 20%, and higher earnings individuals may have to pay an additional 3.8% net investment income tax. And then he breaks it down more into, again, what it is with copying Trudeau and everything else. So here's the breakdown as to where they get the number from. A separate proposal would first raise the top ordinary rate to 39.6%. It will be 43.4% with the additional net investment income tax, which I'm sure is based on just for the highest 1% earners and everything else. Now, he also wants to increase the net investment income tax by 1.2% points above $400,000. So you make over $400,000, you're going to be paying an additional 1.2% on that. Together, the proposals would increase the top marginal rate on long-term capital gains and qualified dividends to 44.6%. 43.4, and then again, it's already at whatever the percent is, and they're going to increase again 1.2. Yeah, so 43.4% plus 1.2 gets you that 44.6% overall. If you're the highest earners, which is crazy. And I'm taking a look at these graphs here because I'm someone who's a math teacher who loves graphs. We're looking at the highest proposed capital gains tax in the last 70 years. And right here is where Grant Cardone references back to when Reagan landslide victory against Jimmy Carter after Jimmy Carter was in office for these higher tax rates and everything else. So we had the higher tax rates here, and then boom, because of that, then the country voted red by a landslide and voted Ronald Reagan in there. The reason why is because, Republicans known for tax cuts and tax breaks for the ultra wealthy. Here's your rate cuts going down here, and that means that was the idea, is to boost the economy and everything else. So very, very crazy to think about for sure. Now, I wanted to know okay, Fridge, you don't make $1 million. Not even close. Yeah, I know. Okay. And, if you are watching this video and make over $1 million, let me know what you do. If you need someone to work for you, I will do it, whatever it is. But on a serious note, okay, Fridge, what does this mean for the economy, though? Okay, what does it mean for the economy? This is going to impact my investments at all? Because think about it. If these taxes go too high, you might have people are not going to sell off their investments and sell off their assets for profits. They're going to be holding their assets longer. And they're going to be it's going to be slowing down the growth of the economy because you don't have as much money being pushed into the economy. Not as much money being pushed into the economy, it slows the growth down. It slows down the GDP, slows down that gross domestic product, slows down the economy growth overall in the U.S., which is why tax cuts come in usually to benefit the wealthy to kind of reboost up that economy and everything else. So what does that mean? Well, so according to this article here, according to this data, this is from 2012, but, it still makes a valid point here from this advisory group. As you can see here with the maximum capital gains tax rate and the S&P 500 index return, so that's the stock market return of the U.S. here. As you will see here, this doesn't really mean a lot. Here's where you have the highest rate here, and we still had a really, really strong economy. This is a 30-40% return, pulls back a little bit towards 20%, give or take, but we still have that strong economy return, even with a higher tax rate. And if that's not enough to tell you, let's bring in some statistics, because I teach statistics at the high school level. So we have what's called R squared. So R squared focuses on essentially the correlation between two different variables, essentially. Okay. And it's the correlation of determination. And essentially what it focuses on is when this number is very, very close to 1 or very, very close to -1, that's when you have more of that correlation. This number is at 0 according to their calculations and their sample and everything else here, which means that from 1954 to 2012, there's no correlation between the stock market return and the higher percent capital gains tax rates. There's nothing. It's a big scatter plot. It's a bunch of just dots all over the place here. And this line is just basically saying there's nothing, there's no pattern. To put it into perspective, this is an example here. You can just Google what R squared is essentially in statistics. But this is an example right here of showing you have that negative correlation. This is an example where you have positive correlation over here. This right here is 0. There's no correlation. There's no relationship between the annual return of the stock market compared to higher tax rates, which is good because I don't want my investments to have a negative correlation when we have higher rates. If we had higher rates and a negative correlation, I'm going to start being okay, to buy the dip opportunity or it's a sell my assets now before rates go too high. But there's no correlation. It's 0. And they do even more between, this is the S&P annual index return versus the change in maximum. So this is just talking about the change in the percents between the capital gains. Still, no correlation. Makes my life a lot easier, right? This is shown again. This is the relation between maximum capital gains tax and the S&P index return in terms of just, a linear graph here. As you can see, not much change is happening here. It's basically hovering around 0 to 0.18 down to 0.2, but not really any correlation whatsoever, which is what I like to hear, because the tax percent won't impact me, and thankfully it looks like it won't impact the economy. Only time will tell, of course, but I'm just using previous data along with it. Now, we talk about benefits of lower tax rates and everything else here. Again, here's more data with, again, the maximum capital gains rate versus the annual percent change in the real GDP. So now we're comparing the economic growth compared to the maximum capital gains tax rate. And again, a correlation of 0.14. The higher values is you want it close to 1 or -1. +1 means you have a positive correlation. -1 means you have a negative correlation. This is 0.14, so it's 0 to little change in terms of there being any kind of correlation here, which to me I think is great. It definitely makes my life a lot better in terms of my investments in in the stock market and everything else. Now, just to wrap it up here, just because I've been talking about hopefully showing you some insights on things, right? Former Democratic senator says Biden's new capital gains tax proposal aimed at billionaires has no chance of passing. So a former senator from North Dakota, Heidi Heitkamp, probably didn't say that right, expressed skepticism on the Joe Biden-led administration of the capital gains tax, with saying that there's no chance of passing. Okay. The policy aims to level the playing field between high ordinary income and investment income earners. And she says that it is a political document. And don't forget, it's an election year, and this could be very well a chance of being it for a political document in terms of trying to get those votes. Because if you think about it, if you're someone who's like a low income earner, middle income earner, whatever, and I know, and I hear that Joe Biden's fighting for equality amongst taxes between the upper class and the middle class. Tax the upper class, tax the wealthiest, don't tax the lower to mid income. If I see that he's even trying to push that narrative on, I might be more likely to vote for him, because maybe if he gets back in office, maybe I save some money in the next couple of years. Maybe I do, maybe I don't. Maybe it passes, maybe it doesn't. I don't really know. But it gives that voter some hope into saying, you know what, maybe if I vote for him, I might be able to save some money on taxes next year or the following year or whatever. So that's what my interpretation, and again, this is my opinion on this point here, is that she's bringing up this idea saying it's a political document to try to get those votes in for the election year to go back into office for 4 more years. That's what my take is for it. But they say no chance of passing. And if you take a look, again, at how the House is built up, it's a majority Republicans. So right now the Republicans have the House, which means that if this bill goes to the vote, probably going to get rejected, because majority of it's Republicans. We go off majority rules in our government. So this bill is for Democrats in the Democratic side of things. The Republican side overrules them. So we'll see what happens, of course. So, long story short, to summarize things, just to bullet point some important things here. This capital gains tax proposal increase isn't going to impact me, isn't going to impact you. It's proposed to impact the upper 1%, the top 1% of the economy, the top 1% of earners and those kind of people there. Also, it doesn't have any correlation to how the stock market is going to return its values. Still going to invest. I'm still going to dollar cost average. It's not going to impact everything. And people think this is just a political ploy to get votes and everything else. Only time will tell what happens, of course. It is an election year, so we shall wait and see. So if you made this far in the video, we're at 19 minutes. Thank you so much for watching. Again, if you haven't subscribed and you made this far, consider subscribing to the channel. We'll try to get to that 100 subscriber mark by the end, into June. I don't know, I think end of June. It's about 2 months out. Thank you guys so much for watching. As always, hope you guys are making money in the market as per usual, and I will see you guys in the next video.